Welcome to the Explainer. Today, we're going to be doing something a little bit different. We are shattering some of the most deeply ingrained financial rules of thumb we've all been taught to follow. And we're going to do it by testing them against pure, structural math to uncover how the financial system actually works underneath the surface. Okay, let's dive into this. Here is our roadmap for today. We're covering the wealth illusion, the optimal financial ladder, the real cost of housing, beating the market trap, the invisible engine, bonds, and finally, the ultimate law, time. Starting right off with Section 1, the wealth illusion, income versus equity. So we really have to start by completely redefining how we view money. Most of us are taught to just, chase income. But income is basically merely a river. You consume it to pay the bills, to buy groceries, to literally just stay alive this month. But equity, ownership in things that actually grow, that's the reservoir. The river keeps you alive, but the reservoir is what actually makes you free. And that brings us to one of the absolute biggest illusions in personal finance, the traditional 401k versus the Roth IRA. The traditional 401k comes with this massive psychological tax illusion. You look at your balance and you feel rich, completely forgetting that the government essentially owns a huge chunk of that money, and they are going to gladly collect it later. The mathematical reality of a Roth IRA, on the other hand, is tax-free withdrawals. You pay taxes now on the seed, and you pay absolutely nothing on the harvest. And honestly, when you look at the U.S. federal debt rocketing past $35 trillion, history strongly suggests that future tax rates are highly likely to rise to cover that burden. Locking in today's tax rates inside a Roth gives you this incredible immunity from all that future uncertainty. Now, take a look at this number, 44. At the absolute peak of the dot-com bubble in the year 2000, the S&P 500 had a price-to-earnings ratio of 44. To put that into perspective, the historical average is about 17. So investors were literally paying 2.5 times the normal premium for the exact same dollar of corporate profit. This perfectly illustrates the dangerous, totally wild disconnect between the price of an asset and its actual underlying value during a financial mania. And this disconnect happens because of a fascinating concept called reflexivity. It's when the price of something completely detaches from its intrinsic value. And the only reason people keep buying it is this blind belief that someone else will pay even more for it tomorrow. Back in 1929, it was a shoeshine boy giving stock tips. In 1999, it was a taxi driver pitching dot-com startups. By 2006, it was a cocktail waitress buying 3 condos with zero money down. Time and time again, crowds completely confuse their collective enthusiasm for actual mathematical evidence. Moving on to Section 2. The optimal financial ladder, sequence over instinct. Let's do the real math here. Building wealth is rarely about finding that one perfect secret investment. It is almost entirely about the strict mathematical order in which you deploy your money. And here is that exact sequence. Step 1 is just a super basic $1,000 safety net, just so a flat tire doesn't derail your entire life or force you to sell off investments. From there, step 2 is capturing your employer match. I cannot stress this enough. That is an unbeatable, instant 50 to 100% guaranteed return on your money. Step 3, you absolutely have to eliminate high-interest debt because paying off a 20% credit card is a guaranteed 20% return in your pocket. Then you move on to step 4, maxing out the Roth IRA to lock in that tax-free growth we just talked about, followed by step 5, maxing the traditional 401k. And only at step 6 do you finally return to build a full 3 to 6 month emergency fund. If you skip around on these steps, you're costing yourself compounding magic that you literally can never get back. All right, Section 3, the real cost of housing, shattering the 28% rule. Get ready because the cold water reality of today's market is going to fundamentally challenge how you view buying a home. See, there are 2 totally different types of math happening when you buy a house. The bank's math focuses entirely on your gross income. Lenders approve you based on money you haven't even paid taxes on yet. But the real math, the math you actually have to live with every single month, that should be based on a maximum of 35% of your net take-home pay. Because getting approved for a massive mortgage is vastly different from actually being able to afford a home after federal taxes, FICA, healthcare, and groceries are all taken out. Now, what's really interesting about this breakdown is what happens when you strip away the illusions and look at the hidden costs. If you buy a $280,000 house at a 7% interest rate, your principal and interest is about $1,863. Seems manageable, right? But when you add in property tax, insurance, private mortgage insurance, and a very conservative maintenance reserve, your true monthly cost skyrockets to $2,703. So if you're earning an $80,000 salary, this supposedly affordable mortgage just consumed 54% of your actual spendable take-home pay. Ouch. Which leads us to this incredibly stark truth. $130,000. In 2026, to comfortably afford a median-priced American home without plunging your household into severe financial fragility, this is the minimum household income required. The math is the math, and it makes the structural housing problem in this country pretty much impossible to ignore. Section 4. Beating the market trap. Index funds versus stock picking. Back in 2008, Warren Buffett made this famous $1,000,000 bet. He wagered that a completely boring, passive S&P 500 index fund would absolutely destroy a basket of elite, highly paid hedge funds over a decade. And of course, he won. The professionals lost to a fund that literally requires zero skill. But there is an uncomfortable nuance to indexing today that we have to talk about. Because index funds weight by market size, big tech giants now make up roughly 41% of the entire S&P 500 index. That's a level of concentration we haven't seen since the dot-com bubble. If big tech stumbles, the whole index falls. However, the argument for owning the whole index anyway is driven by this absolutely staggering finding from researcher Hendrik Bezembiller. Just 4% of all stocks have driven 100% of the net wealth creation in the U.S. market since 1926. That is wild. The other 96% of stocks collectively performed no better than boring government bonds. So if you try to pick individual stocks, you are statistically overwhelmingly likely to miss that golden 4%, and your portfolio will suffer for it. The index fund wins precisely because it guarantees you own those rare, massive winners. And this brilliantly illustrates the danger of trying to time the market. Seriously, what if you have the worst luck and only invest at all-time highs? Researchers actually ran the numbers, comparing unlucky Bridget, who somehow manages to buy only at absolute market peaks, to Wendy, who sits in cash just waiting for a 10% dip. Counterintuitively, Bridget actually wins over the long run. No way, right? But it's because all-time highs tend to cluster together during bull markets. By waiting on the sidelines for a dip that might literally take years to arrive, Wendy completely misses the market's best days, which absolutely destroys her compounding potential. Okay, Section 5. The invisible engine. Bonds, the foundation of money. We really have to transition away from stocks for a minute to talk about the $130 trillion global bond market. Bonds are the absolute foundation of the financial system. If you don't understand bonds, you simply don't understand why your mortgage costs what it costs or how global money actually moves. But to understand them, you honestly only need to internalize one unbreakable mechanical rule. When interest rates go up, bond prices go down, always, without exception. Because think about it, if the government issues brand new bonds paying 5% interest, literally no one wants to buy your old bond paying 3% unless you drastically drop the price to make it competitive. Let's see how this builds and actually causes real-world chaos. Well, in 2020 and 2021, banks bought massive amounts of long-term bonds at near zero interest rates. But in 2022, the Fed raised rates rapidly. Following our unbreakable rule, the prices of those old bonds completely plummeted. This created massive unrealized losses on bank balance sheets, directly sparking the panic and ultimate collapse of Silicon Valley Bank in March 2023. At the very same time, the yield curve inverted, which is basically a massive warning signal from the bond market that has successfully predicted every single U.S. recession since 1955. And finally, Section 6, the ultimate law, time and survival as a strategy. You know, we often obsess over our rate of return, but time compounds so much harder than money does. Our human brains naturally expect wealth to grow like a staircase, just in a straight, predictable line. But compounding actually functions way more like a ski jump. For a really long time, it looks flat, and then all at once, at the very end, it explodes upward. So the absolutely crucial point is this. There is one number that destroys all compounding forever, and that is 0. If you leverage yourself too much or bet recklessly and take a 50% loss, you don't just need a 50% gain to recover. You need a 100% gain just to get back to where you started. Multiply a lifetime of brilliant returns by 0 even once, and the whole shebang collapses. Surviving the bad years without liquidating is the entire strategy. Just look at the astonishing power of the Rule of 72 here. An early saver puts in just $60,000 over their first 10 years and then completely stops. Never puts in another dime. A late saver starts 10 years later, saving 3 times as long, investing a massive $180,000. Yet the early saver beats the late saver by over $250,000. Why? Simply because by starting early, their money captured those final massive doublings of compounding at the very end of the ski jump. Which leaves us with this final provocative thought. The goal isn't to win big once. It's to never be forced out of the game.
It is time to stop chasing rapid gains, stop trying to outsmart the system, and start respecting the underlying structural math of how finance actually works. Build a resilient sequence that you can actually stick with. Because true wealth isn't about being the smartest person in the room. It's about being the person who simply refuses to leave the game. So, looking at your own financial ladder today, what is the very first step you need to fix to ensure you never get forced out? Thanks for joining me on this explainer, and I will see you next time.